Imagine taking like a $63 million loss just to smash up your own perfectly good factory. That is exactly what some of the biggest Bitcoin miners in the world are doing right now. They aren't going out of business. They're pivoting to AI. Okay, let's unpack this August 11, 2026 market setup.
Yeah, and that pivot is totally dictating the current landscape we're seeing. I mean, the price is trading 24/7, hovering around $64,300, but it's hitting this massive brick wall of resistance just below $65,500.
Right, so it looks like a sleepy, range-bound market on the surface.
Exactly, but underneath, the actual mechanics of who is holding and who is aggressively selling are going through this radical shift.
Okay, so let's look at Keel Infrastructure's Q2 earnings as an example here. They just reported a $140.8 million operating loss.
A huge hit.
Right. And to fund their transition, they sold 1,085 Bitcoin for $75 million in cash. Plus, they raised another $458 million to build a 96-megawatt AI data center up in Quebec.
It's wild. They are taking massive depreciation write-downs just to shut down their mining rigs, and they actually plan to liquidate their entire remaining treasury by late 2026.
So they are acting like industrial landlords who are just gutting their crypto factories to build high-performance computing centers for AI. So what does this actually mean for long-term supply dynamics if our biggest network validators are becoming AI companies?
Well, the AI industry is absolutely desperate for immediate large-scale power infrastructure right now, and Bitcoin miners hold the golden tickets, those massive industrial energy contracts, so they are effectively dumping their crypto reserves to become computing landlords.
The ultimate irony here being that Bitcoin, which gets scrutinized so much for energy consumption, is basically liquidating itself to pay for the AI revolution infrastructure.
Right, and that supply-side turnover is massive. But while corporate miners are dumping their reserves, Wall Street is quietly building these permanent bridges to absorb all of that newly available asset. Look at BlackRock Canada launching their new IBQT ETF.
Wait, the one on the Toronto Stock Exchange. That fund is 97% global equities and only 3% Bitcoin. Why even bother with such a tiny allocation? That just feels like a rounding error.
It's basically a Trojan horse strategy. It's like slipping vitamins into a kid's smoothie,
Oh, I see.
Yeah, traditional conservative investors just wouldn't touch a pure crypto ETF. But by hiding a 3% allocation inside a standard, boring global equity fund, BlackRock is quietly microdosing retirement accounts with Bitcoin exposure.
And doing it under a tiny 0.22% management fee. Is this quiet integration proving that regulatory compliance is the ultimate catalyst for adoption?
I really think so, especially when you see Washington pouring the concrete for those bridges. Yesterday, the FDIC approved deposit insurance for Augustus National Bank.
Right, which is an institution built entirely around digital asset integration.
Exactly. Plus, we have the SEC's August 14 open meeting on regulation crypto, where they are officially categorizing Bitcoin as a functional digital commodity.
So Wall Street and regulators are neatly integrating this, but the actual developers running the network are kind of tearing each other apart over governance. We just saw the spectacular failure of BIP 110.
Oh, totally messy. BIP 110 was the proposed soft fork to ban non-transactional data, like ordinals. It needed 55% miner support to activate.
And it only managed to get, what, 2.53%?
Yeah, just 2.53%.
Wow. And the fallout from that resulted in the lead author, Luke Dash Jr., being stripped of his administrative roles.
He was, yeah. And the technical fallout of that tiny 2.53% support is even more drastic. Because only a tiny fraction of the mining power moved to this new Splinter chain, it just doesn't have the computing muscle to solve the cryptographic puzzles at a normal speed.
Oh, because the network's difficulty algorithm hasn't adjusted.
Exactly. It's still calibrated as if 100% of the miners were working on it. So blocks that should take 10 minutes are taking hours.
Wow.
The Splinter chain halted after just 2 blocks. It's currently trailing the main network by 326 blocks. It will literally take them 6.3 years of sluggish mining just to trigger the automatic difficulty reset.
Here's where it gets really interesting, though.
Yeah.
A lot of people see a stalled fork and prominent developers getting ousted as a total disaster. But doesn't this actually prove the network's immunity to unilateral developer control?
It absolutely does. A lead architect tried to force a major rule change, and the network just ruthlessly routed around him.
So we are watching this fascinating duality unfold in real time.
We really are. On one hand, Bitcoin's governance remains aggressively decentralized, rejecting any single point of control.
Yeah.
But simultaneously, the asset itself is becoming a highly regulated traditional commodity. It's being microdosed into Wall Street portfolios, while its original mining infrastructure gets cannibalized for the AI boom.
It's a completely different landscape for you to navigate compared to just a short time ago, which leaves you with something to chew on as we wrap up this deep dive.
Let's hear it.
As those corporate miners pivot to AI data centers and Wall Street permanently absorbs all that available supply, what happens to the grassroots cypherpunk culture that originally fought so hard for the network's independence? If the revolutionaries sell their stakes to the institutions, who's actually left to guard the code?